Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, ASC Lease Accounting Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our slide deck and handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters. We have Laura Jones and Jacqueline Stensland, both senior managers here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Jacqueline to go over the agenda.
Hi, everyone. Thanks for joining. We do have a pretty riveting agenda to go over ASC topic 842. We'll be discussing lease identification and objectives of the new 842 standards, focusing on some key terms, so understanding some of the new terminology that is critical to the lease recognition, impacts and consideration of related party and month-to-month leasing arrangements, some financial statement presentation matters and how the recognition of 842 impacts the financials, and then lastly, some transition reliefs and practical expedients that can be adopted upon adopting the new standard. I'm going to turn it back over to Amy. I think we're going to kick it off with a polling question.
All right, yes, so our first polling question is, which of the following best describes your company's current status in adopting topic 842? A, have not started. B, assessing the impact. C, implementation in progress. Or D, implementation complete. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit the submit button. And if you cannot see the submit button, you will need to just enlarge your slide area. And it looks like most have responded. We'll leave this up another 5 seconds. All right, here are the results.
Okay, we are mixed bag across the board. It looks like all stages of implementation, but that's great. I think that our presentation should target kind of all of these stages, so hopefully it will be helpful. So why change? As you can see here, it has been estimated that there are approximately 1.25 trillion off-balance sheet operating lease commitments for SEC registrants. So that's not even including private companies. And really, one of the industries that's been used in examples the most is the airline industry. Alaska Airlines' June 2018 10Q indicates a gross $7.8 billion in aircraft and $400 million of facilities leases in its lease commitment footnote, which is about 26% of total assets and 39% of total liabilities that are off balance sheet. Similarly, Delta Airlines' December 2017 financials had an estimated $53 billion in assets and $39 billion in liabilities in its commitment schedule. So in essence, many leases are somewhat akin to debt in that they will be paid over the duration of the lease term, and yet many of these leases have been kind of relegated to that lease commitment footnote of the financial statements with no asset or liability being reflected on the balance sheet. So that's kind of where this standard came from and why it came to be. Under the new standard, ASC 842, regardless of lease type, all leases are presented on the balance sheet as right-of-use assets with a corresponding right-of-use liability. Originally, under ASC 840, there was a bright line test of 4 thresholds, which you might all remember. And because it was such a bright line test, leases were purposely structured to pass the test and to qualify as operating leases so that companies didn't have to go through the exercise of capitalizing them. However, under ASC 842, to determine whether a lease is an operating lease or what's now called a finance lease, historically a capital lease, there's no longer this bright line test. It's more of a principles-based approach that should be applied. So there's terminology changes to add right-of-use assets and right-of-use liabilities and to change capital lease to finance lease. But at a high level, capitalization of nearly all leases, regardless of classification, is the resulting impact of adoption. And as a caveat, Laura and I did not write the standard, so we're just the messengers. So moving on, in order to implement the standard, all leases must first be identified. And the definition of a lease, as you can see here, is a contract or a part of a contract that conveys the right to control the use of an asset for a period of time in exchange for consideration. So number one, the asset must be identified, and whether it has substitution rights should be considered. And number two, are you, as the lessee, receiving all of the economic benefits? Do you have decision-making rights? And is control of the specified asset for a specified period of time? And again, that period of time is typically greater than 1 year. What I didn't mention previously is that, yeah, it would be typically greater than a year to qualify, assuming that you're using the short-term lease practical expedient, which we'll also talk about a bit later. So this is a helpful graphic in determining if a contract contains a lease. So the scope of the new lease accounting standard is that it includes arrangements that meet the definition of a lease, including embedded leases and contracts and other arrangements, but it excludes leases of intangible assets, inventory, capital work in process, exploration rights, software licenses. So that's what's in scope. And then as I mentioned on the previous slide, there's 2 criteria: an identified asset, explicitly or implicitly specified, and the supplier has no practical ability to substitute and would not economically benefit from such a substitution, and then the right to control the use of the asset. So decision-making authority over the use of the asset and the ability to obtain substantially all economic benefits from the use of the asset. In other words, it would not meet the identified asset threshold when there's no identified asset or when the supplier has substantive right to substitute, which would be the practical ability to substitute, and it can benefit from exercising that right. The right to control use is important because the right to direct the use of an identified asset means that the customer or the lessee has the right to direct how it's used and for what purpose. And this is a change from historic Topic 840 lease guidance because it used a concept of having controlling physical access versus under ASC 842, it's controlling the use of the asset. So that's kind of a subtle but pretty important difference. So this is another helpful flow chart that the board included in the standard, which depicts the decision process in order to determine if a contract is or if it contains a lease. And I think this is a good chart to reference when you're thinking through whether your contracts contain leases. So you can pull this directly from the standard itself. A bit more on substantive substitution rights. So first of all, again, contracts that do not contain an identified asset are not considered to be leases. However, even contracts that do specify an asset do not qualify as leases if, one, the supplier has the right, excuse me, sorry, if one, the supplier has the right to substitute because it's practical, and two, the supplier benefits from the exercise of its right to substitute. So some common examples where there may be specified assets and agreements, but where there are substantive substitution rights, meaning that the respective asset does not qualify as a lease, would be like, as listed here, scissor lifts, small tools, fencing, traffic barriers, portable restrooms, dumpsters, etc. So now Laura is going to guide us through our first couple of examples to illustrate these concepts a bit more.
Perfect. Thanks, Jacqueline. So based on Jacqueline's addressing of the consideration of whether or not a leasing arrangement exists, we'll just walk through these of how to assess a couple potential leases. So I'll read through these slides just so we have an understanding of the fact pattern. Builders, Inc., a general contractor, enters into a 2-year contract with Crane Company to provide a tower crane for a large project. Crane Company is also required to provide a crane operator to run the crane. And while subcontractors may schedule lifts directly with Crane Company, builder has the final say as to when, where, and which items will be lifted by the crane. And finally, Crane Company is obligated to provide suitable replacement if the crane becomes inoperable for an extended period of time. So does this contract contain a lease? This contract may contain a lease as the crane is implicitly specified in the contract. Substitution is also not practical unless the crane is inoperable. The lessee has the right to direct the use of the crane and obtain substantially all economic benefits of the crane. And then to note, the crane operator is a non-lease component, of which we will define and address further later in the presentation. But now for a second example. Construction company enters into a 3-year managed print services agreement with POA Inc. across its 20 locations. POA provides 65 multifunction printer copier scanners of 2 different models and all servicing and toner for over the 3 years, including initial integration installation. POA is obligated to provide suitable replacement if hardware if it becomes inoperable for an extended period of time at the discretion of construction company. And POA is contractually restricted from replacement for POA's convenience, as this would cause significant disruption to construction company operations. So this contract does contain a lease of the multifunction hardware, as the equipment is specified with a serial number within the agreement. The equipment can only be replaced at the discretion of construction company if inoperable for an extended period of time. Additionally, construction company has the right to control the equipment throughout the life of the contract, including substantially all economic benefits of the equipment and how it's used. And same with the crane operator, the toner and maintenance of the equipment are non-lease components that will be discussed later in the presentation. So to that end, we wanted to point out some typical areas where we are seeing leasing arrangements occur in the construction industry. This could include tower cranes, job trailers, scaffolding, construction elevators, and vehicle fleets. Other areas where there may be rental arrangements that may not meet the criteria for leasing arrangements, depending on circumstances, of course, may be scissor lifts, small tools, dumpsters, temporary fencing and traffic barriers, and portable restrooms, as Jacqueline mentioned previously. So these arrangements typically do not meet the criteria for the lease treatment, given substitution rights if the asset is not specified in the agreement and can be easily replaced. So there's also a practical expedient to adoption that will be addressed further in our presentation as well, whereby immaterial leases do not need to be accounted for under ASC 842, of which some of the following considerations are addressed and the following from the AICPA's Center for Plain English Accounting. So similar to other areas in GAAP, it is generally reasonable for entities to adopt a capitalization threshold in which right-of-use assets and lease liabilities would not be recognized on the balance sheet for leases below that threshold. However, entities should not default to using their existing capitalization threshold in place for property, plant, and equipment, or PP&E, as that threshold does not consider the effect of not recognizing a liability. So it is important to consider the impact in the aggregate and assess quantitative and qualitative factors related to the financial statements and the associated disclosures. For example, lease capitalization policies may also impact liability-driven debt covenants, which PP&E capitalization policies do not. And likewise, the fact that there is a current portion of the right-of-use liability, yet there is not a current portion of the right-of-use asset or of PP&E, there are impacts to popular financial statement user metrics such as current ratio and working capital. So entities and auditors also have significant history with the extent of PP&E purchases that are under the PP&E capitalization thresholds. However, no such history exists with lease capitalization, and many entities are uncovering embedded leases during the auditor review process. And we will discuss the lease and non-lease components later in our presentation, as well as the practical expedient to not bifurcate these components when recording the leases. Therefore, these non-lease components should be considered as part of the capitalization threshold when determining the policy if the practical expedient is elected, whereas there's no similar situation when capitalizing PP&E. So some considerations related to setting the capitalization threshold include: has the impact on the financial statements omitted for right-of-use asset and liability been assessed on a gross basis? It would not be appropriate to consider the net impact of omitting the right-of-use asset and liability. Also, have financial statement user impacts been assessed, such as current ratios and leverage ratios? How will amounts excluded from recognition and measurement due to a lease capitalization policy be handled for disclosures required under the new standard? And have the lease, non-lease components been appropriately considered? So therefore, some leases that may be considered here as immaterial, although not necessarily based on the capitalization policy and reviewing the assets in the aggregate for those that are similar in nature, may be copy machines, postage machines, vending machines, water coolers, and coffee machines. So as you are considering if you have leasing arrangements, it is worth looking into the following areas. First of all would be IT contracts. With your IT services, are there any specified servers that are dedicated only to your company? With regards to service contracts, is there a dedicated production line for certain building materials? Is a tower crane to be provided for construction? Supply contracts, are you provided specific scaffolding or a rented piece of equipment for longer than a year? Inventory if the practical expedient is elected. Inventory management, is there any warehouse space, services, or systems dedicated directly to you over which you have control that houses any inventory of materials or parts to be used on jobs? With regards to fabrication of unique items, is there a dedicated facility used to produce prefabricated building components for you exclusively? Or transportation arrangements, is there a contract in place for the transportation of materials that may specify a dedicated fleet, rail cars, or watercraft? So now we have some tips for identification of leases so that you can provide some sort of structure to the process of identification. First of all, you could send out surveys to project managers or other non-accounting department individuals who may have intimate knowledge of the jobs to understand if there are any contracts in place that may meet the company's capitalization policy or that may not have been previously considered as a leasing or rental arrangement. You could inquire of those who are providing the assets to use as to whether the contracts involve the use of a specified asset. Additionally, you can review recurring vendor payments and the associated contracts. So a way to do this may be to look at the general ledger detail, including in selling general and administrative accounts to see if there are consistent payments made to a vendor each month. And finally, you can perform a physical inspection of any assets to confirm if they are leased or rented as opposed to owned. All right, so I'll turn it back to Amy for another polling question.
All right, thank you. So the second polling question is, in considering embedded leases, which of the examples discussed may be most likely to impact your organization? A, tower crane and job site trailers, B, vehicle fleets, C, building, D, IT contracts, or E, other. And then also, while you're responding, you do have the option to submit questions for the presenters through the Q&A window, and we do see several coming through. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. A few more seconds here. All right, here are the results.
All right, and as we would pretty much anticipate that building leases would probably be the most common that we would see. So thanks, and now I will turn it back over to Jacqueline.
Thanks, Laura. So under ASC 840, classification was one of the most important aspects of lease accounting since the results impacted whether a lease was on balance sheet or not. But now, under 842, since most leases are on balance sheet, lease classification could become less of a factor, and these terms are more relevant because they really impact the amounts that end up being reported. So all of these terms listed will impact the initial recognition of the right of use asset and liability. So diving into them individually. So first, lease classification. So these are the conditions that trigger finance lease classification versus operating lease. So the first 4 conditions of lease classification are fairly similar to legacy GAAP, except that there's no longer any bright lines or specific numerical values that automatically trigger a finance lease classification. The 5th criteria, however, is new under 842. So the first criteria is pretty straightforward. Does ownership transfer by the end of the lease term? And if yes, then it's a finance lease. Number 2, the purchase option. So if it's reasonably certain, is a pretty high threshold, and it should be interpreted to have the same meaning as reasonably assured that was used in topic 840. So whether the purchase option is reasonably certain to be exercised is the next trigger. Then number 3 is the lease term is for the major part of the remaining economic life. And you really need to consider all options that are reasonably certain to be exercised when determining the lease term. And then also to note, this isn't applicable when a lease is entered into near the end of its economic life, which I think, generally makes sense. Number 4 is that the present value of lease payments is substantially all of the asset's fair value. And so regarding 3 and 4, lease term and the present value of lease payments, you can't simply default to the legacy topic 840 bright line tests in evaluating the criteria listed. The new leasing guidance, however, does state that a reasonable approach to assessing these criteria is to conclude that a finance lease results if either the lease term is equal to 75% or more of the remaining economic life of the leased asset, or the present value of lease payment plus any residual value guarantee equals or exceeds 90% of the fair value of the leased asset. So there is kind of it's a reasonable approach to consider that old guidance, but again, trying to get away from the bright line tests and kind of thinking about it a little bit substance over form from that standpoint. And then 5, specialized nature. So as previously noted, the 5th criteria is new under topic 842. And the main item to be considered is whether the lessor is expected to have an alternative use for the leased asset at the end of the lease term. And if no alternative use, the arrangement should be classified as a finance lease, as it could be argued that substantially all of the leased asset's economic utility is transferred to or consumed by the lessee. Again, what we really want to be reiterating here is that if it's not a finance lease, then it's an operating lease, but either way, under 842, it is still capitalized onto the balance sheet. So Laura will discuss the impact of the different classifications between finance and operating later in the presentation, but just as a general reminder, all of them, or nearly all leases, will be capitalized regardless of classification. And then there is a little note here as well that in contrast to legacy GAAP under topic 842, the lease classification must be determined at lease commencement, which is the date in which the lessor makes the underlying asset available for use to a lease. Under 840, lease classification was determined at inception, which is the date that the principal terms are agreed to. So whenever, it used to be that when you signed the lease agreement, that's when that was the when you did this determination, but now it is once lease commences. Non-lease components. So after determining that the contract contains a lease, an entity must identify the separate lease and non-lease components, as well as identify any non-components. So regarding lease components, a contract may include multiple lease components for different underlying assets. And an asset will be considered a separate lease component if the lessee can benefit from use of the asset together on its own or using other readily available resources. Non-lease components are goods and services provided to the lessee that are separate from that right to use the leased asset. So examples of non-lease components could be 2 years of scheduled maintenance on a leased vehicle, or maybe security for a job site, or janitorial services for a leased property when those services are specified in the lease. So those are considered to be non-lease components, which should also be considered when determining this calculation for the right of use asset and liability. Topic 842 does allow for a policy election in which the lessee may choose not to separate lease and non-lease components and can account for them as one single lease component instead. So we'll talk a little bit more about practical expedience later, but as a note, even though these must be identified, they can be accounted for as one single lease component. Here we have a listing of some non-lease components. So these are distinct elements of a contract that are not related to securing the use of the leased asset. And these are just some general examples. So this first one is similar to what Laura talked about previously. You're providing the operation of a lease asset on behalf of the lessee. So the operator of a tower crane comes with renting that tower crane. Training lessee personnel to operate an asset, repair or maintenance of a leased asset, management services, parking spaces, common area maintenance charges. You see these a lot in property, building leases, landscaping service, security services, consumable supplies, management services. So these are all some non-lease components that just are good to kind of keep in mind because those are something that would need to be considered as well. So this isn't a perfect list, and management has to kind of come up with their own internal process in order to identify non-lease components, but this is just a good general list of things to potentially consider. So then, when we're thinking about lease versus non-lease component types, this kind of breaks it down and provides some examples and reasoning. So the first two, fixed payments and variable payments for use of the asset, these are both considered to be lease components because the rental payments are directly transfer the right to use the underlying asset. So examples there are base rent to use the space or mileage-based payments on a vehicle or a piece of equipment. Whereas the next two, common area maintenance, so CAM charges or other services, so some examples, security, janitorial services, administrative services, or building HVAC, public space lighting, parking lot maintenance, these are all considered to be non-lease components. They transfer a good or a service to the lessee, but they don't relate directly to that underlying asset that is being leased. And then kind of the third category here is non-components. So reimbursement of lessor expenses or administrative tasks to initiate the lease, those aren't considered to be lease components at all, because a landlord's not required to pay the lessee, is required to pay, but the lessee doesn't directly receive a good or a service. So it's not the lessee and the lessor are not receiving a direct good or service. Examples there are property taxes or insurance, legal fees, and contracting costs. And now I will turn it back to Amy for another polling question.
All right, thank you. The third polling question is, what are the most common non-lease components you will be considering during your implementation? A, reimbursement of lessor expenses, such as property taxes, insurance. B, common area maintenance expenses. C, administrative tasks to initiate the lease, such as legal fees, contracting costs. Or D, other services. And then also just a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, it looks like most have responded. So here are the results.
All right, so most are saying CAM charges, followed by maybe reimbursement of lesser expenses. So this was a little bit of a trick question because number 1 and number 3 are technically non-components, whereas number 2 and number 4 were non-lease components. But in any event, it's helpful. These are all things that you're seeing in your leases. So good to know that these are going to be now hopefully on a little bit more on your radar if they haven't been already. All right, so the lease term is considered to be the non-cancelable period for which the lessee has the right to use an underlying asset, plus renewal options that the lessee is reasonably certain to exercise, but excluding termination options that the lessee is reasonably certain not to exercise, and options to extend or not terminate that are controlled by the lessor. So reasonably certain, again, is intended to be a very high threshold and similar to reasonably insured language that was used in ASC Topic 840. So while it's not defined, it's higher than a probable, so generally believed to be about 75% or more. So when identifying the lease term, the following factors should be considered: contract-based factors, if the contract contains a substantial penalty for failure to renew or extend the lease; asset-based factors, if the leased asset is difficult to procure, the lessee may have a significant economic incentive to exercise renewal or extension options; entity-based factors, if the lessee plans to invest significant time and money installing or integrating the leased asset into its operations; dismantling the leased asset and replacing it would be disruptive and costly, definitely a factor to consider. Market-based factors, the contractual renewal rate may be well below market rates for similar assets at the date the option is exercisable, so the expectation would be that it would be then renewed. And then when it comes to reassessing the lease term, once the lease term has been established, it should really only be reassessed when certain things occur. So there's really 4 things that could occur. 1 is a significant event or a significant change in circumstances within the lessee's control directly affects whether the lease is certain to exercise an option or to extend, or the lessee elects to exercise an option even though the lessee previously determined it wasn't reasonably certain to do so. And then on the contrary, the lessee elects not to exercise an option even though the lessee previously determined it was reasonably certain to do so. Or lastly, an event written into the contract obliges the lessee to exercise or not to exercise an option to extend or terminate the lease. So a few examples, the lease may require the lessee to extend the lease term if, say, the leased asset is used for less than 1,000 hours during an initial lease term, and then if this condition is met, the lessee would have to reassess the previously determined lease term. So that it comes to the end of the lease term and 1,000 hours were not used, so they're required to then extend the lease until the 1,000 hours is used. That would be an example of when you'd need to reassess the lease term. On the other hand, if the lessee decides to exit a significant line of business in which the leased asset is used, then the lessee would reevaluate the lease term, especially if it has the contractual ability to terminate the lease early. Because obviously, if you're not going to be using the asset because you're disposing of a line of business, whenever that line of business is going to dispose and that lease is going to be terminated, you'd want to adjust the lease term accordingly. Lease payments. So under ASC Topic 842, lease payments comprise of the following components. So one is fixed payments, fixed lease payments, including fixed payments specified in the lease agreement, and in substance fixed payments, less any lease incentives paid or payable to the lessee. Variable lease payments, too. Variable lease payments are rental payments that a lessee agrees to make that aren't fixed at lease commencement. And variable payments that depend on an index or a rate should be included in lease payments and should be measured using the index or rate at lease commencement. Under 842, the accounting for variable lease payments is similar to how such payments were treated under Topic 840, which is most variable lease payments are ignored at lease commencement other than those that depend on an index or rate and are accounted for as period expenses. So 3 and 4, purchase options and penalty payments. The exercise price of an option to purchase the underlying asset and penalty payments for terminating the lease should be included in lease payments if the lessee is reasonably certain to exercise that option or reasonably certain to terminate the lease. And then 5, residual value guarantees. A lessee should include in lease payments the amount that is probable of being owed under the residual value guarantee at the end of the lease term. So to the extent your lease agreements have those, you would definitely want to be including the residual value guarantee in the lease payment calculation. Discount rate. So a lessee, this was something that was, a concept under when you have capital leases under Topic 840. A lessee is required to determine the discount rate on a lease-by-lease basis and should use the rate implicit in the lease whenever that's readily determinable. And then if the rate implicit in the lease is not readily determinable, a lessee may use its incremental borrowing rate. So in actual practice, I personally don't necessarily see a ton where the rate is specified in the lease agreement or implicit in the lease agreement. So what would need to be included would be the calculated fair value of the leased asset, periodic payments due under the lease, lessor's expected residual value, and the deferred initial direct cost for the leased asset, all to be known at lease commencement. So often that's not something you are able to derive, in which case, if the rate implicit in the lease isn't known or calculable, then the lessee should use its incremental borrowing rate at lease commencement. And Topic 842 defines the incremental borrowing base rate as the rate of interest that a lessee would have to pay to borrow on collateralized basis over a similar lease term, an amount equal to the lease payments in a similar economic environment. So really, judgment is pretty necessary in determining the incremental borrowing rate. Companies should be able to support their estimates by using all available evidence, and some options of what you could use in order to determine this rate would be rates that you're being charged by third-party creditors in some recent borrowings, if any are applicable, observable risk-free interest rates and credit spreads for similar commercial debt, quotes from third-party lending institutions of the borrowing rate that would be charged if the lessee elected to purchase the asset on installment over the same term. And so when determining the incremental borrowing rate, the lessee should assume the debt would be collateralized by the underlying leased asset. So as is with anything and any adoption, it's helpful just to have good documentation and good thought process behind what you do determine to be your incremental borrowing rate is kind of the takeaway. Lease incentives. So lessees often receive incentives from a lessor to encourage a lessee to sign the lease. They may be in the form of an upfront cash payment, payments to cover lessee costs, like maybe moving expenses, or the lessor's assumption of the lessee's pre-existing lease with a third party. So lease incentives may also include rent-free periods or rent holidays or cash allowances to help fund tenant improvements. All of these things kind of fall under that lease incentive category. So for a lessee, lease incentives actually reduce the fixed lease payments, which affects the lease classification and reduce the initial measurement of the right of use asset and lease liability. And as an additional note regarding tenant improvement allowances, it is important to determine whether the improvement represents a lessee or a lessor asset. Only payments for lessee assets should be accounted for as a lease incentive. So this isn't unlike ASC 840, but just kind of a reminder on lease improvements. Lease modification. So lease agreements are sometimes amended subsequent to their origination date, and Topic 842 defines a lease modification as a change to the terms and conditions of a contract that results in a change in the scope of or the consideration for a lease. So new and separate contracts, a lease modification should be accounted for as an actually entirely new contract, completely separate from the original lease agreement when both of these criteria are met. So one is that the modification grants the lessee an additional right of use, not included in the original lease, and two, the payments increase commensurate with the standalone price for the additional right of use. So as a kind of an example of this, if you assume a company is leasing 2 trailers and after the lease commencement date, the lessor amended the existing contract to add a 3rd trailer, and the new all-in lease cost represents the market rates of 3 versus 2 trailers, then that amendment would be accounted for as a separate contract because it introduces a new right of use asset that wasn't part of the original contract, which is that 3rd trailer, and 2, the total lease payments increase commensurate with adding that 3rd trailer. So the criteria would be met. When a modification is not accounted for as a new and separate contract is if it does not provide the lessee with additional right of use and if the lease payments do not increase commensurate with the standalone price for the additional right of use asset, then it's not accounted for as a separate contract. So if it doesn't meet both of those criteria to be classified as a new contract, reassess the classification, remeasure the lease liability using the discount rate determined at the modification date, the commencement of the modification, and then record the corresponding adjustment to the right of use asset. And for modifications that are fully or partially terminate an existing lease, you'd record a gain or a loss for the difference between that reduction in right of use asset and the corresponding lease liability. And now I will turn it back to Laura to go over some other nuances, including related party leases.
Sounds great. Thanks, Jacqueline. So with regards to related party leases and how the standard impacts how these leases are recognized, there's some key terminology that ASC 840, the legacy leasing standard, has the threshold to meet the criteria to be a lease was based off of economic substance. However, now under the current leasing standard, the terminology is shifted to be based on legally enforceable terms and conditions. So the intent of the FASB was to simplify, but legal enforceability can be difficult to determine without legal counsel. So if there are expired related party leases for which payments are still being made, but there's not a formal agreement in place, this could require legal consultation to determine enforceability. So there's also a risk of the acceleration of leasehold improvement depreciation. As if a lease is not deemed to be in place, it would not be appropriate to have leasehold improvements capitalized and depreciated over the life of that agreement. So we advise that related party leases are put into writing with terms that approximate that economic substance to bridge the gap to legal enforceability and therefore clarify that arrangement in place. So we know that month-to-month leasing arrangements are quite common, and we'll address later with regards to transition reliefs to ASC 842, although a practical expedient allows for short-term leases to be excluded from the standard. However, it is important to determine the intent of that leasing arrangement. So these leases may not be considered enforceable if both the lessee and the lessor can terminate without permission of the other party with an insignificant penalty. So it's important that if the lease is enforceable, that renewal and term options must be exercisable by both parties. Are the economic incentives to indicate that renewal terms present would result in the exercising of the option is a key consideration. Additionally, are there facts and circumstances to indicate that there are implicit lease terms? For example, if you have made significant leasehold improvements, as we discussed earlier, on property with a short related party lease term, or the property has been specifically tailored to fit the needs of the company, this may indicate that it is not truly the intent of the arrangement, and therefore the substance of the month-to-month lease may indicate that there's likely a leasing arrangement in place, and therefore should be recognized accordingly. Another consideration here would be that related party lease situation if there's common ownership of the leased property and the company leasing the property, so the same lessee, lessor, the likelihood of the lessor moving or the lessee finding a new tenant unless there's intent to move to a new property is probably not high. So now that all leases are on balance sheet, there are financial statement impacts of which you should be aware, particularly as you're having discussions with your bank or sureties about how the statements may look different this reporting cycle. So the balance sheet will now present that right-of-use asset, as Jacqueline discussed, for both financing and operating leases. To note, as we also discussed, there will be that current portion of the right-of-use asset, of the right-of-use liability without a corresponding current portion of the asset. The income statement will present amortization and interest expense for financing leases and a single lease expense on a straight line basis for operating leases. With regards to cash flows, for financing leases, cash flows will break out principal payments as financing classification and operating classification for all other payments such as interest, whereas operating leases will classify all lease payments within the operating section of the statement of cash flows. And here are some additional descriptions of how these changes to financial presentation can be viewed. So under both operating and financing leases, there's a gross presentation of the right-of-use asset and liabilities. It is not deemed appropriate to commingle the types of leases on the balance sheet. There will also be front-loaded interest expense for financing leases, but this will be an EBITDA add-back. And while both types of leases are financial liabilities, finance lease liabilities are more so the equivalent of debt, but operating lease liabilities are not really debt-like, but rather are operating in nature. As unlike with financing leases, for operating leases, the entire lease expense is included in EBITDA. And this is because ASC 842 requires the lease expense from an operating lease to be presented as a single line item in the operating section of the income statement, even if you do find it easier to think of an operating lease as still having an interest component and an amortization component. ASC further prescribes that all lease payments made under an operating lease be presented as operating cash flows. So we've touched on some of these items in our previous discussions, but based on new balance sheet classifications, there are impacts to working capital and related ratios. Due to increased assets, there will be a lower return on assets and lower equity to asset ratios. And for financing leases, there would be those increased expenses in early years, but associated larger EBITDA add back. Now I'll pass back to Jacqueline for some transition reliefs.
Thanks, Laura. Yes, so these are the great private company, optional practical expedients and policy elections that can be made, and we've touched on a number of these throughout the presentation. But the first one we have listed here, transition election package of 3. So at adoption, you do not need to reassess expired or existing contracts for embedded lease, proper lease classification, or capitalization of initial direct costs. So hopefully that kind of removes some of the accounting burden. Hindsight, you may elect to apply hindsight to existing leases to determine lease term and asset impairment. Land easements, if you have land easements at adoption, you do not need to reassess whether existing or expired land easements contain a lease. Short-term leases, this one we've talked about a lot. You may elect to exclude leases of 12 months or less from the new requirements, and that's something that I would expect many people would be adopting that. Capitalization threshold, immaterial leases do not need to be accounted for under 842. Again, you'd want good documentation of how they're not immaterial in the aggregate. Lease and non-lease components, lessees and lessors may make an accounting policy election to choose not to separate the non-lease and lease components, so you can combine those into one. And then discount rate portfolio approach, again, you can use a single discount rate to a portfolio of leases if it doesn't result in a materially different present value than using individual discount rates for each lease. Hopefully those are something you can consider using and kind of will lighten the load on the adoption. And then I think, Amy, we've got another polling question, final polling question.
Yes, so the last question is, what area of implementing the new lease standard do you anticipate to be the most challenging for your organization? And your options are A, data collection, B, resources, C, accounting, or D, system requirements. And then also for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handouts. And then we're also sending them via email tomorrow along with a recording of this webcast. All right, we'll do another 10 seconds just to make sure everyone gets their CPE. All right, here are the results.
All right, it looks like appropriately accounting for changes and updating processes, controls, and disclosures is kind of the number 1, then data collection with number 2. So for sure, I think all of these, depending on the number of leases companies have and depending how far along you are in the implementation process, I'm sure that, yeah, it makes sense that these would be potential challenges as you work through it. So last but not least, disclosures and footnotes. As is the case with any new standards or really any standard, there are some additional footnote disclosures. Quantitatively, there's quite a bit you can see on the left-hand column that you would need to disclose in a footnote related to these right-of-use assets and liabilities. And then there's also some qualitative information you'd want to include. And one thing to point out on the qualitative side is that if you are to adopt accounting policy elections on practical expedients, then those would need to be disclosed in that footnote that you have adopted those so that it's clear to users. Of course, any areas of significant judgment and assumptions, material residual value guarantees are also disclosed. And again, as always the case, the disclosures have to be material, but I would estimate that most of the stuff on the left-hand column would be disclosed and then as needed on the qualitative side. And so that concludes our presentation. We really, really appreciate all of you joining. It was a lot of content to get through, but hopefully it's helpful as you're working towards adoption and considering things you have going on, and we appreciate answering any questions. I know there are a few in the chat. I might just take one, and Laura, of course, feel free to chime in, but we have a question: what's the difference between lease commencement and lease inception? And commencement is when you actually take direct control of using the specific asset, so the date the agreement starts, whereas inception would be when you actually sign the agreement, so when you've entered into a lease, which sometimes that's a year before, maybe that's only a few months before, or maybe it's same day as commencement, but that's kind of the difference there. And I think I've had other people asking about if you can take a gap departure and omit and just kind of avoid excuse me, avoid adopting altogether. And I think on that one, Laura, feel free to give your thoughts too, but you probably need to meet and discuss with your service providers on if that's really the best route. I think this standard is, I mean, it will be here to stay, I would think. And so if you take a gap departure this year, you're really going to have one extending into the future. So just something to consider. You'd need to talk with your service providers. But yeah, it can definitely be some additional work and potential headaches to get this adopted. So understand the question.
Yeah, and we also have a question too about, isn't there also a distinct criterion when identifying a lease? And yes, that would be that identified asset. So, you know, is there a serial number? Is it a specific floor to a building? Something like that would also be that sort of specified asset threshold there. So absolutely.
I see another one. Did Jacqueline say the lease has to be over a year duration? And maybe this came earlier on, but yes, no, not necessarily, but as was pointed out in that practical expedient slide, if you adopt the practical expedient of omitting leases with less than 12 months, then yes, you wouldn't need to include any of those in adoption. So an option for a practical expedient there.
And also to note, when we were discussing practical expedience with regards to materiality of leases, it would be important to kind of document how you arrived at that conclusion when you're coming to year end and finalizing that position. It wouldn't be appropriate just to state that it was not material. You'd want to do that analysis as well, so you'd have that supporting documentation readily available and to go through those paces.
There's a question on materials for presentation. Amy or Carly, do you know the answer on that one?
Yeah, so they can download them now from their console, and we're also going to be sending them out via email tomorrow to all registrants. Perfect.
And another question is, well, what is the official required adoption period for private companies? It's December 15th, you know, for periods starting after December 15th, 2021. So it would be in your financial statements starting December 31st, 2021. So sorry, yeah, this upcoming fiscal reporting year. So sorry, December 31st, 2022 would be when you'll see that show up in your statements.
All right, I am going to have to close this out. We are getting close to time, but thank you, Laura and Jacqueline, for a great presentation today. And then also, I want to thank our audience for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer yours, we will do our best to follow up with you after the webcast. Also, feel free to reach out to our presenters if you have additional questions. And then also, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have difficulty downloading it now. And then also in the upper right-hand corner of your console, there is a banner that you can click on to be taken to the registration page for our annual Building Opportunity Conference. This will be held virtually next month, so definitely check that out. And then finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.